Okay, our next topic is intangible assets. And remember, they gain their value from some exclusive right that they convey. So you see some examples of some intangible assets here. Trademarks get their value from the exclusive right to use some symbol or um, other representation of a corporation. When you see a trademark, you should see this little TM, which means registered trademark. Means it's registered with U.S. Patent on Trademark Office. Examples: the Nike swoosh, the apple, the Granny Smith apple with a bite out of it, the golden arches of McDonald's. Those are all examples of trademarks. The Nike swoosh. And they have great value. Some trademarks, the Apple trademark is estimated to have a worth of something like $200 billion. So some are very valuable. Copyrights are exclusive rights to some material that's been created. It could be a movie, it could be a book. The right lasts for the life of the creator plus 70 years. So patents are granted by the patent office. They're an exclusive right to manufacture some product or use some process. Patents have a life of 20 years, non-renewable. Technology, things like software, easiest example there. Um, Licensing rights are rights to often license some character. So they talk about Cedar Fair, the amusement park, in earlier examples, using the Peanuts characters Charles Schulz created. That would be Snoopy, Charlie Brown, all of those. And franchises can be acquired. Subway franchise, McDonald's franchise, something like that. You gain the corporation's permission and right to use something in return for paying a fee. Usually there's two sets of fees on franchises: an upfront fee to acquire the franchise from them, and then continuing fees of some portion of your revenues. And usually you have to buy certain ingredients from them as well. Goodwill is another one. Now, intangibles, just like tangible assets, are valued at cost. So the only way to record goodwill is if you purchase it, if it has a cost attached for it. Now, goodwill you may think of as you are polite to your customers, and so you build up goodwill. Well, that's true, but you don't record that goodwill. The only way you record goodwill is if you acquire it in a business combination. And the way you do that is if you pay more than the fair value of the identifiable assets minus fair value of identifiable liabilities you acquire. If you pay more than that net amount, then the difference is goodwill. So if a company, let's just say Ford acquired Jaguar back in the 80s, and they paid about $2 billion for Jaguar. The identifiable assets net assets were about $1.5 billion. So what did they pay the other $500 million for? Well, for the Jaguar name and reputation. So that was goodwill. So that's goodwill right here. They talk about GAAP does not allow it to be reported as an intangible asset on the balance sheet unless it has been purchased from another company, and it can only be recorded if it's purchased in a business combination. In other words, when you're acquiring a company. Now, intangible assets, just like other assets, are recorded at cost initially. So if you go out and buy a patent from someone else or buy a copyright from someone else, then you pay the acquisition cost for the asset. If you develop a patent on your own, you probably spend a lot of money on research and development. Now, research and development expenditures are expensed as incurred. In other words, you develop a patent on your own, you spend millions of dollars in research and development, and all of that gets expensed, and the patent gets recorded at the cost you incurred in filing for the patent, legal costs and clerical costs, other costs associated with actually filing the patent application. May not seem fair, but that's the way it is. Now, the reason for that is we have to go back to the definition of an asset. Definition of an asset, remember past, present, and future. It is a present resource we own or control arising from a past event or transaction, and it's expected to provide future benefits. Now, it's the future benefits part that's uncertain with research and development. As we are spending that money, we have no idea if it will ever result in any future benefits. So, as a result, current GAAP requires expensing research and development cost as incurred. So, self-developed intangible assets, if Disney creates a movie, and they spend a lot of money in research and development, then much of that's going to get expense. Now, the actual cost of making the movie can be capitalized to the movie. But if some company is out trying to invent something, so think of a pharmaceutical company, and they're spending billions of dollars right now trying to develop some sort of a vaccine or a cure to coronavirus. And so that money they spend on research and development gets expensed as incurred. Okay, now intangible assets break into two categories. Those with limited useful lives and those with unlimited or indefinite useful lives. Now, those assets with unlimited useful lives, and generally speaking, that's trademarks and goodwill, are not amortized. In other words, they stay on the books at their cost, potentially forever. Now, you do have to check them for impairment. Remember, we talked about impairment with tangible assets. You do have to check them for impairment, but theoretically, they could stay on the books forever at the price you paid for them. Now, those assets with limited useful lives, with intangible assets, for example, patents, trademarks, or excuse me, not trademarks, copyrights, software, licensing rights, things like that we acquire, those get amortized. We call it amortized, not depreciated. So it's amortization, not depreciation. But it's the same thing as depreciation. Your book talks about it right here. Systematic and rational allocation of the cost of an intangible asset over its useful life gets amortized over its useful life, almost always on a straight line basis and almost always with zero residual value. Now, is it possible you might have some residual value? Sure. Let's say, go back to Disney, they're developing a new movie. Let's say a new animated movie. And so they spend a lot of money paying animators to draw it and everything else. And their plan is to release it to movie theaters. And so they do that, and they make a lot of money. And then whenever enough people have seen it, it's no longer going to be in movie theaters. Then perhaps they sell it to Turner Classic Movies for them to play, or Netflix, or someone like that. And so they may say, okay, we spent $200 million making this movie, and now we think it has a residual value of $5 million that we can sell it to Netflix for when we're done with it. And so in that case, you would have a residual value. But it's on a straight line basis, just as you calculate straight line depreciation. Okay, and the entries are pretty much the same as you see in depreciation, except we see amortization rather than depreciation. Disposal, exactly the same thing as with tangible assets. We depreciate or amortize it through the point of disposal and then record disposal exactly the same way. Determination of gain or loss exactly the same way as for tangible assets. Okay, let's look at a couple of homework problems. So exercises 9:11 and 9:12. So I didn't move down to those before I started the video. And so there we go. So refer to this table up here and assume each company spent $319,800 at the beginning of the current year for additional developed technology. Because of its proprietary nature, the technology is estimated to have no residual value at the end of its estimated life. Calculate the impact, direction, and amount of the amortization of each of such expenditures would have on each company's income from operations in the current year. Well, it's going to decrease their income from operations. Now here we see for developed technology, Amazon estimates useful lives at 3.9 years. Alphabet, which is the company that owns Google, at 4.1 years, and TripAdvisor at 2 years. So you can see we're going to take basically half of the cost as depreciation in year one for TripAdvisor, where it's only going to be less than a quarter for Alphabet. So, and again, I didn't think to set it up here, but there we see Amazon, the 3.9 years. So amortization expense is $82,000 for Alphabet. 4.1 years, $78,000, and for TripAdvisor, half, $59,900. Okay, so 12 is pretty long. So computing and reporting acquisition and amortization of 3 different intangible assets. Bluestone Company had 3 intangible assets at the end of the current year, so compute the acquisition cost for each intangible asset. Patent purchase this year from Miller Company on January 1st for a cash cost of $9,300. When purchased, the patent had an estimated life of 15 years, so their cost is $9,300 on that one. Trademark that was registered with the federal government, they purchased for $10,000. Management estimated the trademark could be worth as much as $200,000 because of its indefinite life. Well, it doesn't matter what they think it could be worth. They value it at what they paid for it, $10,000. And computer licensing rights were purchased this year, January 1 for $60,000, expected to have 5-year life. So their acquisition costs are $9,300, $10,000, and $60,000. And there we have those. And time is about to run out on me, so we will stop there, and I'll just restart this one at the beginning of the next video.